Welcome to the Tesla Daily News podcast for Monday, April 13th, 2026. Today, we're tracking three big drivers for Tesla investors: a key autonomy regulatory win in Europe, fresh data on demand and pricing pressure in major EV markets, and Tesla's longer-term bets on chips and heavy trucks that could reshape the margin story. Story 1. Tesla gets a regulatory green light for full self-driving supervised in Europe, starting in the Netherlands. The hook is simple. Europe just gave Tesla its most important autonomy beachhead yet. Context: for years, Tesla's valuation has hinged on software and autonomy, but Europe's regulatory environment has been a limiter. Getting approved in even one EU country matters because it sets precedent and can open doors. Details: Dutch vehicle regulators approved Tesla's full self-driving, supervised system for use on public roads after more than 1.5 years of testing on a proving ground and public roads. The regulators stressed this is still a driver assistance system, not full autonomy. The driver remains responsible and must be ready to take over at any time, with driver attention monitoring and alerts. Impact: for investors, this is meaningful in three ways. First, it's a pathway to expand high-margin software revenue in Europe, where subscription attachment could lift average revenue per vehicle. Second, it improves Tesla's competitive positioning as Chinese and European brands push advanced driver assistance as a key differentiator. Third, it can influence analyst sentiment. Regulatory progress reduces one of the biggest execution risks in Tesla's autonomy narrative. Takeaway: watch for Tesla to leverage the Dutch approval into an EU-wide process. The Netherlands regulator said it will apply to the European Commission, and then EU member states would vote on broader usage. For Tesla watchers, the key question is not just is it allowed, but how fast can it scale, and what features will Europe permit compared with the US build? Story 2. Tesla's Q1 numbers underline a mixed fundamental picture: deliveries up, energy storage down. Hook: Tesla delivered more cars than last year, but still came in light versus expectations, and energy storage deployments disappointed. Context: near-term stock moves still react most to deliveries, margins, and guidance. Tesla bulls talk autonomy and robots, but Wall Street models the core auto and energy cash flows first. Details from market coverage: Tesla's Q1 deliveries were reported at 358,023 vehicles, up about 6% year-over-year, but below an estimate around 365,000. On the energy side, reported deployments were 8.8 gigawatt-hours, down from about 10.4 a year earlier and well below a consensus cited near 14.4. Impact: a delivery miss typically pressures near-term revenue expectations and can raise concerns about pricing and demand elasticity. The energy miss matters because energy has been one of Tesla's more promising margin stabilizers. If deployments are lumpy or constrained, it complicates the energy offsets auto cyclicality story. Takeaway: into earnings later this month, listen for Tesla's explanations on two fronts. 1. What limited energy deployments, whether it was supply, project timing, or demand, and 2. Whether delivery softness is geographically concentrated or broad-based. Investors should also focus on gross margin and any commentary on price discipline versus volume. Story 3. High fuel prices appear to be boosting near-term Tesla demand in Australia, led by Model Y. Hook: when gasoline spikes, Tesla's top seller gets a sudden lift. Context: macro shocks like oil price moves can rapidly change EV consideration rates, especially among first-time buyers. That can be a near-term catalyst even when the broader EV narrative is noisy. Details: Australian sales reporting for March showed the Model Y as the third best-selling vehicle overall, behind the Ford Ranger and Toyota Hilux. Model Y sales were cited at 2,818 units for March, up 63.4% year-over-year, and nearly double Tesla's average in the first 2 months of 2026. The same report noted searches for EVs jumped sharply, with one source citing a 230% rise on Cars Guide and another citing a 631% jump in new EV searches on AutoTrader after petrol prices spiked. Impact: for Tesla investors, this supports the idea that Tesla can still capture surges in demand because the brand remains synonymous with EVs in many markets. But it also highlights a product mix issue. The Model 3 reportedly did not enjoy the same boost, with March sales cited at 667, down 33% year-over-year. Takeaway: if fuel prices stay elevated, Tesla can see tailwinds, but the bigger question is sustainability. Watch April data and pay attention to whether the lift is largely timing and deliveries, or true demand expansion. Story 4. Competition is accelerating in Europe and the UK, and the numbers are getting harder for legacy brands, not just Tesla. Hook: Chinese automakers are moving from niche to meaningful share across Europe, and that changes the pricing game for everyone. Context: Tesla's biggest structural risk in vehicles is not just demand, but margin compression from aggressive competitors, especially those with cost advantages in batteries and vertically integrated supply chains. Details: A European auto industry report cited Chinese-made car imports into the EU rising to just over 1 million units in 2025, up about 30.7% year-over-year. Chinese-made vehicles were cited at about 7% of EU sales in 2025, up from 5% the year before. In the UK, separate reporting noted that almost 1 in 10 new models delivered in 2025 was sold by a Chinese company, around 196,000 units, up from 98,000 the year prior. And forecast Chinese brands reaching 15% market share this year and 20% by 2027. Impact: For Tesla, that means the EV market grows so Tesla wins logic is outdated in Europe. Growth can accrue to BYD and others, especially at lower price points. That tends to force Tesla to choose between preserving margins or defending share with pricing and incentives. Takeaway: Investors should track Tesla's European pricing, inventory levels, and any evidence of mix shift toward lower margin variants. The competitive set is expanding rapidly, and the market is training consumers to expect more features at lower prices. Story 5. Musk's Terafab chip push gets a potential boost with Intel, but it's a long-dated, high-risk bet. Hook: Elon Musk wants a terawatt of compute per year, and Intel is now publicly joining the effort. Context: Tesla's autonomy and robotics ambitions are compute-hungry. Chip supply constraints and rising costs have become strategic issues for AI-heavy companies. Details: Coverage of the Terafab initiative described an ambition to internalize semiconductor production for Tesla, SpaceX, and xAI, targeting 1 terawatt per year of compute. Intel announced it is joining the Terafab project and on the same day highlighted a gallium nitride chiplet breakthrough, including ultra-thin GaN grown on 300mm wafers and the ability to integrate GaN power electronics with silicon logic on a single chiplet. The reporting emphasized GaN's advantages for high-voltage and radiation-tolerant environments, relevant to space and potentially to power electronics. Impact: Near term, don't expect a financial contribution. Even the bullish framing suggests this could take years and potentially cost enormous sums. But strategically, if Tesla can reduce dependence on external AI hardware supply, it could improve long-term unit economics for autonomy compute and robotics. Takeaway: Treat Terafab as optionality. The investor question is whether Tesla can pursue this without pressuring near-term free cash flow or distracting from execution in vehicles and energy. Story 6. Tesla Semi is finally ramping, but even success may not move the needle quickly. Hook: Tesla's big rig could become a real business line, yet still underwhelm impatient investors. Context: The Semi matters because it targets a large commercial market, and it can tie into future autonomy on highway routes. But it has been delayed for years. Details: Recent investor commentary cited a 2026 goal of between 5,000 and 15,000 Semi units, with starting prices around $300,000. Pilot operators have reported strong performance, including runs exceeding 400 miles. Reports also noted Tesla reduced weight by about 1,000 pounds, and combined with a 2,000-pound federal EV weight exemption, the 500-mile version could reach payload parity with comparable diesel Class 8 trucks. Impact: If Tesla executes a steady ramp, Semi can add revenue and diversify Tesla's narrative beyond consumer vehicles. But in the near term, volumes are likely small relative to Tesla's overall scale. The bigger impact would come later if fleet economics prove compelling and Tesla's manufacturing costs fall. Takeaway: Watch production ramp milestones at the Nevada facility and any indications of gross margin. Investors should avoid overmodeling Semi contribution in the next 1 to 2 years. Let's wrap it up. Today's big themes were a meaningful autonomy regulatory win in the Netherlands that could open a broader EU pathway, a reminder from Q1 deliveries and energy deployments that the near-term fundamentals still matter, and intensifying competition in Europe that keeps pressure on price and margins. For tomorrow, keep an eye on 2 things: more pre-earnings positioning as Tesla heads toward its April earnings date, and any follow-up signals on European FSD expansion beyond the Netherlands. If you found this helpful, subscribe to the Tesla Daily News podcast and follow us for your daily, investor-focused Tesla update.